Morning children. In the last class we learnt about how goodwill is, what is goodwill and how goodwill is calculated. Things have been seen under partnership accounting. Today in the plus 2 accountancy course chapter 5 we will see about admission of partner accounts under admission of a partner, that we are going to see in this chapter. In partnership, the composition of partners, they may, after a period of time, when they establish a good reputation, they may want to expand the business, for which they may admit a new partner into the business with the consent of other existing partners. So, admission can take place only when the existing partners agree, because their rights are in question. They may have to sacrifice their rights in favor of an incoming partner. So, let us see how admission is done and what are the accounting implications we have to do it in preparing the final accounts. The purpose of admission of new partner may be to raise additional capital, because the business want to expand, so they need additional capital for expansion of business, or managerial skill, new skills, because the person, those who have started the business, must have become old and they want to induct new blood, that is with the new managerial skills of the new partner, or both, that is capital as well as managerial skill. So, under the section as per the Partnership Act 1932, section 31(1) of the Indian Partnership Act 1932, subjected to contract between partners, because there is an agreement between the existing partners. Subjected to it, no person shall be introduced as a partner into the firm without the consent of all the existing partners. That is nothing but a veto right. So, new partner cannot be admitted until every partner agreed to. What are the problem may come up? What are the problems may come up at the time of admission? Because existing business must have run for quite number of years, they must be having good amount of assets and reserves. Now, when a new partner comes in, he has no right to claim over the assets, previous assets. He can claim rights over the present asset, which will be valued now at the time of admission. Let us see what are the problems. Distribution of accumulated profits, reserves and losses. If there is any reserves, reserves means a part of profit is set aside to meet any emergency or any future exigencies, or profit, accumulated profit not distributed, they are called accumulated profits. Reserves, losses, if there is any carried forward losses, that has to be transferred to older partners. So, you have to distribute the accumulated profits and reserves and losses. Revaluation of assets and liabilities. The assets and liabilities. The assets are recorded at the historical cost, because they must have purchased asset quite number of years back. They have to be valued to the present value. So, you have to revalue the assets and as well as liabilities. The financial position of the business has to be updated, you can say updated. So, with which by revaluing the assets and liabilities, there may be a plus or there may be a minus. They have to be borne by the older partners. A separate account is to be prepared. Determination of new profit ratio and sacrificing ratio. So, when a new partner is admitted, the composition of the partnership takes place, or you can say dissolution of partnership. The partnership is dissolved and a new partnership is formed. So, we have to find out new ratio and we have to find out sacrificing ratio. Sacrificing ratio is nothing but the existing partners sacrifice a part of their profit in favor of incoming partner or new partner. So, that ratio has to be calculated, how much each has to contribute, the old partners have to contribute in favor of new partner. Adjustment of goodwill, we have seen in the 4th chapter what is goodwill, what are the various factors affecting the goodwill and how to calculate various methods. You must have worked out. So, now that has to be adjusted. During admission, the incoming partner has to bring his share of goodwill, he has to pay for it, because he is purchasing profit share from the existing partners. So, he has to compensate the old partners. This is the right way of doing it. So, for that purpose we calculate the goodwill and his share, because if he, let us say the goodwill is 1 lakh and he gets 1/4 of the future profits of the company, he has to pay rupees 25,000, that is 1/4 of the total goodwill he has to pay to the existing partners or old partners. So, for that we have to treat the goodwill. Adjustment of capital on the basis of new profit ratio. So, the capital of the new partner in the new firm is known. Now, old partners, after doing lot of adjustments such as transferring the reserves and profits, revaluation profits and losses, then such things will increase or decrease their capital. So, their capital are also adjusted on the basis of the new partner's capital. Excess money may be transferred to their personal accounts. Such is the problems are faced at the time of admission of partner. So, let us see one by one how each things are dealt. The distribution of accumulated profits and reserves. So, I told you accumulated profits are nothing but profit and loss earned in previous year and not distributed to the partners. They are called accumulated profits. There may be accumulated losses also. Reserves. Reserves are meant for some purpose. There are particular reserves and general reserve. Any reserve is nothing but a part of profit set aside to meet the emergency. Such type of accumulated reserves by the previous years or belongs to old partners, they are to be credited to the old partners capital account. So, for that we have a journal entry. Transferring the accumulated profit and reserves. Simple journal entry, distribute the reserves and accumulated profits to the partners capital account, old partners in old ratio. Profit and loss appropriation account, general reserve, reserve fund, workman compensation fund. This you must be seeing new. Workman, what is workman compensation fund? This is the amount set aside for the workman's welfare. Now, since it is going to become a new company, whatever accumulated and not utilized will be transferred to old partners. Investment fluctuation fund is a separate fund created from the profit or appropriated from the profit and loss account or net profit to meet any shortcomings while selling the investments, while realizing the investments, whatever the market value, fall in market due to market value, if the expected value is not reached, then we said to be losing the investments value. To compensate that, we have a separate fund, investment fluctuation fund. Such funds, if it is not utilized, they will be distributed to the old partners in old ratio. And if there is any loss, so this alone a journal entry for transferring the accumulated profits and various reserves and funds. If there is any loss, the journal entry is reversed. that is old partners capital account to profit and loss account, that is in old ratio. You have to distribute it to the partners capital account. Next, revaluation of assets and liabilities. There are separate illustrations to elucidate how the things are done in chapters in a textbook, very neat way by giving small illustrations. Kindly do it. There are practical workings exercise part at the rear of the chapter, so we can check it out. Next is revaluation of assets and liabilities. Assets and liabilities are recorded at the historical cost or the cost at which they are purchased, and they are recorded quite number of years before. Now, at the time of admission of new partner, the assets and liabilities has to be brought to the present value. So, while valuing, the new partner has to agree to it, and the existing partners will present a new balance sheet. Revaluation account is nothing but a nominal account. Whatever the profit or loss comes has to be transferred to old partners. If a asset's value increases, if any asset, if its value increases, it leads to profit, and vice versa. That is, decrease in value of asset will lead to loss. Same way for liabilities, decrease in liability leads to profit and increase in liabilities leads to loss. And unrecorded assets leads to profit, unrecorded liability leads to loss. Such way the profits are credited and losses are debited. Same like our profit and loss account, profit items on the credit side, loss items on the debit side, and balance it out, we will find if any balancing figure, that is if the profit items are more than loss items, we get revaluation profit. If the loss items are more than the profit items, then we get a balancing figure here, which is revaluation loss, which ultimately transferred to old partners. If it is here, then we will credit to the partners, old partners. If it is here, that is revaluation loss, partners capital account will be debited and realization account will be credited. So, this is the account, revaluation account. The revaluation account is opened to record increase or decrease in assets and liabilities. It is just a record. It is also called as profit and loss adjustment account. So, it is also can be called as profit and loss adjustment account. So, separate examples are given with a quite number of illustrations how revaluation is treated in partnership accounting. Third adjustment, that is calculating new profit share ratio and sacrificing ratio. New profit sharing ratio means after admission, that is a new partner is admitted and old partners, they may find the partnership comes under dissolution and a new partnership comes into existence. The ratio in which the future profits will be shared after admission is called as new profit sharing ratio, and it includes the new partner also. If the new profit sharing ratio is not agreed, the partners will share the profits and losses equally. This to be underlined. If there is no agreed ratio, then after admission of new partner, if there is no agreement, then everybody will be treated equal. Then what is sacrificing ratio? Who sacrifices? The old partner sacrifice. Not all, sometimes some of them sacrifice a part of their earning in favor of the new partner. Sacrificing ratio is the proportion of profit which is sacrificed or forgone by the old partners in favor of new partner. So, the ratio in which the existing partner, or you can say old partners, sacrifice their part of profit in favor of new partner. What is the purpose of it? It is to share the goodwill brought in by the new partner. Why do you calculate the sacrificing ratio? The sacrifice will be compensated, mitigated. The share sacrifice is calculated. How it is calculated? By deducting new share from the old share, because the old partner's old share will be more and now present share may be lesser. So, whatever he loses, he has to be compensated. So, how it is calculated? Share sacrificed is nothing but old share minus new share, or you can say ratio of share sacrificed by the old partners. The sum of the share of the new partner is nothing but total sacrifice of existing partners. So, either way it is understood that the new partner, what he gets? Nothing but the sacrifice made by the old partners. So, it is calculated under different methods. When the new share is given, when the new share is not given, how the partners sacrifice. So, there are so many conditions and it is given in a chart form in your book. It is given in the book how the new profit sharing ratio and sacrificing ratio is calculated, when new ratio is given, when the new ratio is not given. In case not given, we have to calculate the new ratio, then we have to find out the sacrificing ratio. At the end, we have to find out sacrificing ratio. When share of sacrifice is given, when there is a proportion of sacrifice is given, when there is a proportion of share sacrifice is not given. So, these are the various conditions. Around 7 conditions are given in the book. Each one is explained practically by giving suitable illustrations. Go through it, do the exercise part, understand each method is distinct from one another. So, understand it. You are sure to get a question from this, how to calculate new ratio and sacrificing ratio. So, kindly take little more interest to do practical sums to understand the concept, how new ratio and sacrificing ratio are calculated, which is very important. Next, about the goodwill. Goodwill is nothing but the reputation or the present value of the future earnings. That is, when a new partner brings cash towards goodwill, that is, goodwill is calculated for at the time of admission, a new partner has to compensate the old partners for their sacrifice. So, he has to bring capital to claim over the rights on assets of the company. He has to bring in capital. To purchase the profit of the existing partners, he has to compensate them. That is nothing but goodwill. He is paying for the sacrifice made by the old partners. So, he has to bring in capital, cash towards capital. Sometimes he may bring some assets also. Instead of cash, he may bring assets. So, when he brings cash towards a goodwill, how it is recorded? When a new partner does not bring goodwill in cash or kind is nothing but other assets. When he is unable to bring, how it is treated? When he brings only a part of goodwill in cash, remaining in kind. Part of goodwill in cash or kind. So, rest he is not unable to bring. When there is an existing goodwill, already old partners have recorded goodwill account in their accounts, how it is treated. Let us see each condition one by one. When he brings, new partner brings in goodwill plus his share of capital in cash. When he brings in goodwill in cash, that has to be transferred to old partners who are all sacrificed for his profit. So, money will come from outside, that is, new partner will bring in, capital will be kept separate, the goodwill share of the new partner will be distributed to the old partners from his capital account. The journal entry is, when he is able to bring in cash towards goodwill, cash account or bank account. When he brings in cash, cash account will be debited. When he brings through bank, it is bank account, that is through check. cash account or bank account debit to old partner's capital account. So, whatever he brings in cash, that will be directly given to old partners according to their sacrifice. For goodwill brought in kind, if he brings in the asset form, respective asset, whatever the asset he brings, sometimes he may bring in the form of land, sometimes he may bring in the form of investment. So, respective asset account debit to old partners capital. Instead of bank, debit the respective asset. If the goodwill share is withdrawn by partners, so new partner gives them the compensation, that is nothing but share of goodwill, that is withdrawn by the new old partners. In such case, old partners capital account debit to bank account if it is withdrawn. If they retain it, nothing is done. If they withdraw, then additionally one more journal entry is made. When it does not bring, when a new partner brings in only capital, he is unable to bring anything towards goodwill. In such cases, amount of goodwill share of the new partner will be debited from his capital account, new partner's capital account, and it will be transferred to old partner's capital account. That means, whatever he brought in as capital, from that amount goodwill share will be taken out and given to old partners in sacrificing ratio. So, his capital will reduce in the new company. You must understand, the goodwill share amount will be taken out from the capital of the new partner and it will be paid to the old partners. For that, new partners capital account debit to old partners or capital account or current account. You must understand why capital account, current account are given. Refer to chapter 3. The capital account is maintained in two ways, that is fixed capital and fluctuating capital. Under fixed capital method, current account is maintained. Under fluctuating method, capital account is maintained. So, you must understand which account has to be credited. Now, that is when he is unable to bring. Initially, we saw when he is able to bring cash towards goodwill share, and next is when he unable to bring goodwill in cash or kind. Now, if he brings a part of amount, only a part of amount is as a cash, and how it is treated, bank account or cash account. Let us say he has to bring in 25,000, he brings only 10,000. So, whatever comes, cash or bank account debit 10,000, unable to bring 15,000. So, that amount will be taken out from his capital account, new partner's capital account, his capital account will be reduced. So, 10,000, 15,000, total 25,000 will be distributed to the old partners. So, whatever you are able to bring, debit it in the cash account, unable to bring, if he unable to bring, whatever the amount he is unable to bring, that is to be debited from his capital account and distribute it to the old partners in sacrificing ratio. And the last condition, that is existing goodwill. If there is any existing goodwill in the old company, the old partner's balance sheet shows on the asset side under the head fixed asset, if there is an goodwill account, then it has to be written off. It has to be made zero on admission. In the new balance sheet, it is shown as zero. For that, you have to write off the goodwill account. So, to write off the goodwill account, we have to make a entry old partners capital account to goodwill account. So, the goodwill account, which is an asset which is having a debit balance, by crediting it, it will become zero. So, old partners capital account will be debited, and this is to be done in old ratio, not in sacrificing ratio, because the new partner is nowhere concerned. So, old partners capital account in old ratio to goodwill account. This entry has to be made. Now, after doing all this, we have to prepare the capital account of the partners, capital account of the all partners, and adjust their capital, and then prepare a new balance sheet after admission. That is the end of the process of making a admission of new partner in a partnership firm. Now, let us have a small revision. What are the, how a new partner, what for a new partner is admitted? When they need additional capital and managerial skill or both. A new partner can be admitted only when all the partners agree for taking a new partner into the partnership firm. By that, old partnership comes to the end and new partnership takes place. That you must understand. What are the various accounting things we see while the partners are admitted? The distribution of accumulated profits and reserves and losses to the old partners. Assets and liabilities are revalued, result of which may be a revaluation profit or revaluation loss. This also to be transferred to old partners. We have to find out new profit sharing ratio and sacrificing ratio, because the composition getting changed, and need to adjust for goodwill. That is nothing but the new partner has to compensate the old partners for their sacrifice. A goodwill share of him has to be brought inside to the accounting. How it is treated? Adjustment of capital on the basis of new profit sharing ratio if agreed. So, the new profit sharing ratio and the new capital has to be made. Now, how the accumulated profits and reserves are losses are distributed? Profit and loss appropriation account, that is undistributed profits, general reserve, reserve fund, both are more or less same. Workman compensation fund, investment fluctuation fund, these are all nothing but accumulated profits to meet some emergencies. They are now transferred to old partners capital account in old ratio. If there is any loss, reverse the journal entry, that is all. Old partners capital account debit to profit and loss account if they are in old ratio, that is loss if any. Then revaluation of assets and liabilities. It is a nominal account prepared at the time of admission of new partner, by which we bring the assets to the present value, because assets and liabilities are recorded in the historical cost. So, they are at the time of admission, they have to be revalued, and if there is any profit or loss as a result of revaluation will be transferred to the old partners in old ratio. Now, for that we prepare this account. Items credited are nothing but profit items, on debit loss items. What are the profit items? Increase in asset, decrease in liabilities. Very simple. By looking at the example, we can very well understand. Increase in asset value, concerned asset, or decrease in liability will result in profit items, and vice versa. If there is a reduction of asset value, it will be debited. If there is an increase in liability, it will be credited. So, such things are put here. Then balanced, result of which may be revaluation profit or revaluation loss, which will be transferred to partners capital account by passing a journal entry revaluation. That is, if it is a profit item, revaluation profit, revaluation account to old partners capital account. If it is loss, revaluation loss, then partners capital account to revaluation account. Then finding out new profit sharing ratio and sacrificing ratio. Sacrificing ratio is nothing but old share minus new share, and sufficient illustrations are given under 7 methods, each one with a suitable illustrations. Kindly go through, and ample number of videos for explaining how new share is calculated and how sacrificing ratio is calculated. So, understand each one surely to get one more question on it. And how the goodwill is treated. Goodwill is treated when it is brought in cash, when it is brought in partially cash or both, and when there is a existing goodwill under 4 conditions. When it is brought in cash, then it is cash account to old partners capital account. Whatever the share of goodwill of the new partner when he brings in cash, that will be directly transferred to old partners capital account. When he brings in the form of asset not in cash, respective asset account debit to old partners capital account. When it is withdrawn by the partners, such cash given by the new partner goodwill share is withdrawn, then old partners bank account, the old partners capital account to bank account. When he unable to bring in goodwill share by the new partner, it will be taken out from his capital account and it will be transferred to old partners capital account. New partners capital account to old partners capital account. When a partner brings a part of it, then part of it will be debited to cash account and balance will be taken out from his capital account and it will be transferred to old partners capital account in sacrificing ratio. And fourth condition, when there is an existing goodwill which is from the old business, that has to be made nil by transferring to old partners, that is an asset has to be brought down. So, old partners capital account in old ratio. Previous 3 conditions we used sacrificing ratio, but in this existing goodwill when it is written off, it is written off on old ratio. Old partners capital account to goodwill account. With that we come to the end of the chapter 5. What are the problems and how it is treated in admission of partners. Thank you children. Thank you very much.